But it's a pleasure being here. As Professor Bulletin told you, I've been here before, and it's good to come back. I come back every year, and it seems that you have a great course. It's sort of a responsibility being the last one to speak, but I hope I can hold that. What I prepare here, and I really want this to be as interactive as you can, so please interrupt if you have questions in between. It's a brief overview of how we see private equity in Brazil, and I think what's more interesting to you, it's why private equity in Latin America, it's similar or different from private equity in other places. I think it's especially interesting to see how it compares to traditional private equity as done in the developed world in the US, Europe. After that, I'm going to talk a little bit about GP and what we do and the way we do things and how the two things related. If we still have time, there is some cases that I'm gonna try to go through of some of the investments we did. Of course, only the good ones, the bad ones, we left it out. So this is going to be really fast. And why do we start it in Brazil, and why do we like Brazil? We do business all over Latin America, but we do concentrate strongly in Brazil. We like that because it's a big economy, it's a big country. So there's going to be more people adding up in Brazil over the next 20 years than in Europe and the US combined. So there's a lot of people born in every year, a lot of consumers, a lot of growth in the country. It's a massive country, it's about the same size as the continental US, larger than the EU. This is all old information. This is a little different. It's not a very populated country. It's not, there's a lot less people. How does this work? Anyway. So a lot of less people around in Brazil than in other places. So there's a lot of density, there's a lot of that it can grow. And the reason being that you're going to see afterwards, Brazil is really well developed just in a portion of the country, in the south half. The north half, there's a lot of to go. This is important to us, and that's something that people didn't really recognize a couple of years ago, but I think investors and the financial community have started to recognize. Brazil is a very stable country. It sounds a lot less stable because we have gone through some changes. We had hyperinflation before, but since on the macro side we got things in shape, we've been pretty stable. So if you look at political stability, rule of law, corruption, this is Goldman Sachs data. We are ahead of all the other BRICS and pretty much all the other emerging markets. Brazil has been a stable democracy for about 20 years now. We are fairly technologically advanced, and this is another thing that people don't recognize very much. We will not grow like India and China. Brazil did grow like China and India in the 70s when we went through the process of urbanization. People move in the countryside and move in the cities. But structurally, Brazil will grow more on the 4 to 5% than in the 8 to 10%. But it's enough. It's more than enough, a lot more than we got over the last 20 years. That's what I mentioned before. Development is not fairly spread throughout Brazil. The south of Brazil is fairly developed. The north is not developed yet. And one of the forces for economic development is the development spreading throughout the country. We are very similar to do business. We are very Western style economy. Actually, from a demographic standpoint, we're very similar to the US. And and if you walk around Brazil, it's culturally speaking, we're very Western, which makes doing business easily and copying ideas from the US easier as well, which is something that we've done in the past. What's different now? And this is all old news. So Brazil was like that for years, and for years it was a big promise, but things were quite complicated. What has recently changed, and changing for the best for us. We've been around for 15 years. I would say the last 5 or 6 years have been the best ones for us. And what have changed, what's really important, is really the macro view of Brazil. So inflation has been under control since '94. Interest rates are still, if not the highest, I think the second or third highest in the world, but we have had single-digit interest rates for the first time over the last 12 months, definitely for the first time during my professional life. We actually have very large reserves, as all the other emerging markets. We have been accumulating reserves. The currency has been appreciating over time. It's probably where it has to be right now. It should not continue to appreciate, but that's important to us. Of course, we did many investments in 98, 99, and doing private equity investments when the currency is devaluing every year, of course, makes getting a good dollar return a lot harder than it has been over the last 5 years or so. This is not that important. From a government standpoint, we are very well balanced. Net debt of the Brazilian government is only 43%. The public debt in Brazil, 43% of GDP. Of course, that compares quite well with most of the world right now. This is something that's also different from most of the large emerging economies. We are a very inward type of economy. Trade is a small portion of our GDP. The main drivers for growth in Brazil are really internal consumption and internal investment. Being isolated, it's not always an advantage, but certainly it is an advantage when something like what happened in 08 happens, because we did better than most of the world because we were a lot more isolated, for example, than Mexico, which is really dependent on the U.S. economy. And this is probably more interesting, I think, because of macro stability, because of sets of reasonably well-implemented social policies, the middle class is growing in Brazil. If you look internally in Brazil, the most important driver of development and wealth and value in Brazil has been an emergence of a much larger middle class. So if you look at those numbers, about 30 million people moved from the DE class, which is about up to $300 a month of household income, into the C, A, and B, which are really the consumers that can afford to buy, a TV set, a fridge, to have, really be part of the normal consumption. This is, 30 million people. That's a lot of people that move it from one to the other in the last, 6 or 7 years. And this is another thing that is important to us and another driver when we look in Brazil, particularly, but most of Latin America. We are under leveraged in all senses. Consumers are under leveraged in the region. The government is generally under leverage, and companies are generally under leverage. So there's a lot of growth that will come for those going to normal levels. It's in spite of the growth that we had, you see that the numbers are still, we are away from what you see in the U.S. or Europe and a lot of the emerging markets. The Brazilian banks are very strong. They have always been very strong. So even throughout 08 and 09, there was still lending going on in Brazil. The Brazilian banks didn't suffer at all from the world financial meltdown because they have very good equity ratios and are very under leverage as anyone else. Going more into the specifics, what are the things that are important to us as private equity investors? I think the one thing that has completely changed the dynamics of the market, and I'm going to show that when we get more specific on the private equity, is that for the last 5 years, we have had a very well-developed public markets in Brazil. So before 2003, for the 10 years up to 2003, there was 52 public offerings in Brazil, and most of them were back in 94, 95, 96. Since 2004, the public markets in Brazil have been one of the most active in the world. Actually, it's the third most active after the US and China. It was the second most active last year any place. So even after the financial meltdown, we had about $19 billion raised in public equities last year in Brazil and 28 offerings. And one thing that is we find particularly interesting for the Brazilian market is that if on one hand you have a very developed public market, the private market, as I can explain, is still really underdeveloped. So private equities, it's really new in Brazil. It's a lot less competitive. There is a lot less capital going around than you see most places, including emerging markets. So we are in a situation right now where we see a lot of growth going on. We see liquidity on the horizon because we do have an active public market. We continue to have interest from strategic partners, but very few competition, very few players are chasing private equity deals. So, going into private equity, and I think that's what's probably more useful than talking about macro Brazil. This is pretty much private equity starts in Latin America in '93. Before that, there was no structural private equity fund of any reasonable size in the region. We raised our first fund in '94, which was a $500 million fund, which is most of the money that was raised there. There was a first wave of, no, I have one here. Oh yeah, it's yeah, I got it. So you have a first wave of development in Latin America, which started in '96, all the way to 2000. So we raised our first fund here in '94, $500 million. We raised our second fund in '97, $800 million, which was a record year, '97, '98. This was driven by a handful of local firms and by several international firms that raised funds locally. The most prominent ones were Advent, Hicks Mills, have a big fund here for Latin America, Morgan Capital, JP Morgan Capital at the time, or Chase Capital at the time, raised a lot of funds. So we had a first wave. This is not much money for international standards, but it was quite a lot of money for Latin America. A lot of that money was chasing privatizations. Privatizations started to happen in Brazil and Argentina, mostly in '94, '95, and they intensified in Brazil in '97, '98. Most of those investments were very bad investments. They were hurt a lot by the Asia crisis, Russian crisis, Argentina, the valuation of that period. So what happens is that most of the players that were around here, they didn't survive the almost completely closing of the Latin American private equity market between 2000 and 2004. So most of the firms disappeared, didn't raise new funds, with basically two exceptions, one being GP and the other one being Advent, which is our most important competitor locally. As Brazil started to grow again, things stabilized, the public markets open, we have a new wave, and of course we're raising a lot more money right now for the region, but the numbers are still fairly small. In 2008, which was a record year for Latin America, it's about $6 billion raised for private equity. There were $40 billion raised for emerging Asia overall. So the numbers are really small when you compare to the public markets and when you compare to other markets in other places. And that's what it's showing here. So this is 2009 data, but if you look 2007, 2000, it's pretty much the same. So you have $16 billion raised for emerging Asia in private equity, and only $2 billion for Latin America, which is pretty much a little more than the East Europe, just 2 times Africa. But if you look historically, there's more private equity money in Africa than actually there is in Brazil. So in spite of a much larger share of the emerging markets GDP, the amount of money available for Latin America is fairly small, which of course we believe it's great, because that means less competition, and has a lot to do about the way we do private equity in the region, which is somewhat different from the more typical model that you see in the US and in other places. And also has to do with the '90s experience, of course. A lot of the investors that put money in private equity in the '90s didn't come back. There were very few funds that made any money raised there. Fortunately, ours was one of the few exceptions. So this is very broad and doesn't mean to be extensive, but generally the way we see private equity in Latin America, it is a business of changing companies from an operational standpoint. You may be chasing growth, you may be chasing a consolidation, you may chase expansion in margins, but leverage and financial engineering, we play a very small role of what you're doing. There have been very few traditional leverage buyouts in Latin America for 2 reasons. Leverage is very expensive, and up to very recently there was no leverage at all. So if you want to change a company, you really need to improve substantially the margins and the size and the way the company is run. You are usually buying family-owned businesses. There has been no public to private transactions yet in Latin America. There have been several pipes, including some of them that we did, where you actually buy a portion of a public company that is still controlled by a family or by the regional investors, and you take a joint control position, but not a traditional public to private. It's mostly control, and there is very low competition. if you compare that to emerging Asia, which has a much more developed private equity business, there are more than 100 private equity funds in India, there's more than 100 private equity funds in Asia. I think one thing, especially when you think about, China has been a lot driven by joint ventures because of the restrictions of ownership. It's hard to get control if you're operating in both China and India. Most of us and most of our competitors will seek control. And of course, you don't have as much competition as you have in Europe and the US, but you have substantial competition going to the markets. Is this changing? A little bit, but we don't believe it's changing that much. So of course, competition is growing in Latin America. Of course, there's more money, there's more players today than there was 5 years ago, but probably still pretty much the same size as it was 10 years ago. So it is changing, but we believe we're going to continue to be for many years a market where there is less private equity money going around. The main source of deals are very complicated, family-owned businesses that need a lot of change in the way they're run on a day-to-day. And because of that, you need to have control. You don't want to have a minority stake in a family-owned business because the chances that you're going to really be able to change the business if you don't have control are small. So getting to GP and how we position ourselves and how we take advantage of the market, and then a brief history of what we do. We are the largest Latin American private equity firm, been around for 15 years. We raised about $5 billion, have done about 50 deals overall, very different industries, different sectors. Our team is not very large. We have 13 investment professionals. We're going to have 14 in July when Sergio, which is somewhere around here, join us, right there. I think we have developed a good reputation, which comes not only from what we did over the last 15 years, but also from our founders. GP was founded by 3 very successful Brazilians that did a number of investments on their own. And the most prominent one was a brewery in Brazil that started as Brahma, bought a competitor, bought Quilmes in Argentina, merged with Interbrew in Belgium, and then bought Anheuser-Busch. So Anheuser-Busch is actually controlled by 3 Brazilians nowadays that were the founders of GP. They are not involved with GP anymore, and I'm going to explain why. And I think our model, and I'm going to talk that a little bit, is a little different from the typical private equity model in another sense, which has nothing to do with Brazil, has to do about our history and the way we think, that we are the largest investors in our fund. GP itself is a public company, so we have our own capital, and we are by far the largest investors in our funds, and as a consequence, by far the largest investors in every one of our portfolio companies. So I talk about that, how we were founded. So we raised 2 funds in the 90s, a small local fund in 2001. In 2003 and 2004, when things were quite complicated in Brazil, we had become a small portion of our founder businesses because they were so successful with the brewery. That was good for me and from a group of other more junior partners because we bought the firm from them. So at the point there was a first generation change in the company. We bought out the business from the founders, and the company is now controlled by myself and other 3 partners that actually manage the firm. We took advantage of the good years of Brazil. So in 2005 we raised our 3rd fund, which was a lot smaller from the others. We were still coming back. Then we raised our larger funds in 2007, and we are in the process of closing our 5th fund, which we're still fundraising. Now it has $1 billion. You should have a little more than that over time. That's the structure I talked about. This is sort of a complicated chart, but as I said, we are a public company. We are listed. We are Bermuda-based. We're listed in Luxembourg, and we trade in Brazil. We actively trade in Brazil. We have a large float. That business is controlled by a partnership where all the partners are and has all the voting interests here. And GP is the general partner of our funds and also the largest limited partner by far of the private equity funds. So we have committed about $500 million to our funds. We have about an asset base of about $1 billion, out of which nowadays about half of that is cash and half of that are stakes we have in the 3 current funds, 3, 4, and 5. We also have an asset management business, basically a hedge fund business in Brazil, but it's run totally separate from our private equity business. This is our team. We have 9 partners right now, including our CFO, our internal counsel. I think what we like about our team are basically 3 things. One, we are fairly young, all of us, but we have been working for a long time in private equity and a long time together. So the 4 more senior partners have been together for over 10 years, including myself. The second thing that we like, most of us have operational experience. Another instance that we are quite different from the typical private equity firm in the West is that quite often we actually leave the day-to-day of GP and go run one of our portfolio companies. So 2 of my partners now are currently CEOs of portfolio companies. I was a CEO of one of portfolio companies between 2004 and 2007. So out of the 9 partners, 5 or 6 of us have been either CEOs or CFOs of large companies, most of cases one of our portfolio companies. How we do things there, and I think this has a lot to do about the differences between private equity in Latin America when you compare to the developed world. I think the first thing, as I said, we are very active in our portfolio companies. We cannot run the day-to-day of every company, and of course every company is run as an independent unit, but we seek control or joint control of every investment that we do, most of the times control, because we want to actively manage the companies and really drive the companies and do things the way we do. So if you look across the industries, and we invest in a broad range of industries, the way compensation is structured, the way budgeting is structured, the way we manage the capital structure of the company, general corporate policies, values, they're very similar across every company, and we make sure that they are. 90% of the time, we change the management teams. Again, we are usually buying family-owned businesses, so you don't want to bring the management team. So we're going to bring usually a combination of people that has worked with us before, that do things the way we do, plus industry expertise that we hire from the industry. We combine that into a new management team, and we're very active. Of course, we're on the board, but I speak daily, almost daily, with the CEOs of the portfolio companies that are under my responsibility at GP. This is sort of an obvious statement, but we focus on value. You know, the only way we make money is that if we increase profitability through growth and margin expansion. Leverage can play a role, but it will be a much smaller role than the actual improvement in the profitability of the business. Then this is our option. We have decided that nowadays we only invest in established businesses. In the 90s, we did everything. We did venture capital, we did growth capital, we did small businesses, we did large businesses, we did joint ventures, we did minorities, we did majority. We decided as a firm that we only want to invest in mature businesses that are easily to change and that provide the risk return that we want to accomplish. Mid to large size companies for Latin American standards. Usually nowadays we're going to write a check of $200 million. So you talk about firm values of 300 to 500 on that neighborhood. We are very focused in Brazil. All of us are Brazilians. All the partners are Brazilians. But we look at things everywhere in Latin America. So we've been actively looking for investments in Colombia. We have looked at many things in Mexico. And we have one investment, which is an oil field service company that has most of its operations outside of Brazil. This is an interesting chart that we like, this is the investments that we did in Fund 3, 4, or 5, and I'm going to go into each of them. But we are, as a source of transactions, most of them are family-owned businesses. We have been successful buying non-core assets of usually multinationals. You know, that happens often that for some reason they have a business that they don't like in Latin America and we seek to buy it, especially when there is no strategic competition because you can get on a good price. And in some instances, we have partnered with the controlling shareholders of listed companies that are not, most of the time, were not doing well, and we buy a very important stake. We take over management, sort of reposition a company that's public but is not performing well. But most of them most of the time we talk about family-owned businesses, and then we combine either organic growth, a growth strategy, a consolidation strategy, or a turnaround strategy, and sometimes the three of them to create value. We did a lot of consolidation. We like a lot when we see industries, they're a lot more fragmented in Brazil than they are in other places. We like turnarounds, and we did some very profound turnarounds in companies that were very close to bankruptcy. And of course, we are looking for growth overall in multiple instances. As I said, we invest in every single in every single industry. We don't. The way we think about investments is that if one of our investors want to make a bet in Brazil, or they want to make a bet in commodities, or they want to make a bet in natural resources, they probably have best investment vehicles than GP. If you want to just play the macro card at GP, you much rather buy at Brazil. You much rather just buy the index and move from there. If you want to play the commodity play, which is a great play in Brazil, there are best vehicles that we do that GP. We usually like investments where we control the key variables. So we are not betting that Brazil will do well, and we are not betting that some commodity that we don't control will increase in prices. So you usually look in a specific sector, in a specific company where, for some reason, there is some inefficiency that we can deal with, and where the key variable will going to be our ability to execute on that strategy. That's why we always come back to turnarounds, growth, strategic repositioning, consolidation, and we really find a specific company in a sector. Of course, we do look at services quite a bit, because services is usually a good investment for private equity. It's not capital intensive, it demands a lot of people, it demands a lot of management ability, so you can change a lot of things. But you see, we've done some industry plays in consumer goods, we did a lot of service plays. We have some commodity exposure in San Antonio, and some commodity exposure in Magnesita, which I don't know where it is, but anyway. Yeah, right here, it's an industrial company, but we are never taking direct commodity exposure in any of the business that we invest in. I think better than going, a good example of what we do is probably the case studies that we have, unless someone has a specific question about the industry or about Brazil. No questions? Okay. So I think the case studies are the best way to show the way we do things and how they fit in the environment that we have for private equity in Brazil. So I've chosen a couple of them. They're very different and from each other. And I think they give a good flavor of the way we do things. The first one, Submarino, it's a very good company. It's something that we would not do nowadays, although we did quite successfully in the 90s. Submarino was basically a copycat of Amazon. We work embedded in the internet bubble generally in Brazil. We just thought it was a good opportunity. We thought it was value there. So for a while, I personally became a venture capitalist, which was something absolutely new to us. But between 99 and 98 and 2001, I was personally only working with internet companies. We built a portfolio of 15 portfolio companies, internet related, out of which one, Submarino, did extremely well, 2 or 3 did quite well, 11 were a disaster. And a disaster in Brazil is a lot harder to handle than a disaster in the US, because you cannot just close the doors and walk away. Unwinding a business in Brazil, it's a lot of work. So we decided that we were not going to do venture capital anymore, but we did some good investments, and I think Submarino was a good one. So Submarino was founded within our offices at GP. It started from zero. One of my partners that had a lot of retail experience stepped out of GP for a while and went to found Submarino. We found a very interesting market in 2 senses. One, in Brazil, you had a complete absence of category killers. You had the department stores, but you didn't have Toys R Us, you didn't have, of course they're not relevant anymore because of Amazon, but at the time, Toys R Us, Virgin, Barnes & Noble, they were all very relevant businesses in the West. There were no similar things of similar size in Brazil. So we thought that was very interesting. Brazilians are usually early takers of technology. Actually, the penetration of internet in Brazil, it's way beyond what you found. You would generally would expect, given the level of development. So we founded Submarino. We built a team with people that we know. It started from zero. It was a really tough start, as always. But because we couldn't raise, we raised a lot of capital in 2000, 2001, but of course after 2001 there was no way we could raise capital for the business. So we had to turn around the business and make it profitable. So actually we became profitable in 2002, actually faster than Amazon became. We were EBITDA positive before Amazon was EBITDA positive. Of course, a very small size. But we started to have massive growth. We took the company public in 2004. We exited the business in 2007 after merging the business with our main competitors, which was a subsidiary of a traditional retail business in Brazil, forming a very large business. And actually, what is now called B2W, which is the company that Submarino was merged into, is the second largest e-commerce business in the world. The one, in spite of being only in Brazil, is second only to Amazon, and generated $300 million in EBITDA last year, and is generally doing quite well. So in this case, basically what we saw was an opportunity to create a business from zero where there is a niche, but where we could pool resources that we had in-house and where we can put experience that we had in-house. And of course, it was really important, the ability to raise capital during the initial phase of the internet. I was actually living in the US between 1999 and 2001, just because we were trying to get all that crazy venture capital, internet money into our portfolio companies. We put about $100 million in the 15 internet portfolio companies that we invested in. We took out about 350, out of which 250 was Submarino alone, and we raised another $300 million or $400 million of capital into that companies from international investors. Moving to another one, which is a lot more relevant from what we do today. We, back in 97, when we were just getting started, there was a big wave of privatizations in Brazil. In most cases, we could not play the privatization because there were major strategic interests for the privatizations, so we were not competitive in price. So if we're competing with a US or European multinational, I think it's unlikely that a private equity business will find the type of returns that we seek. But in railroads, because railroads are generally a very local industry, there was no interest at all. There were few clients that want to buy, that were thinking about buying railroads in Brazil, but there were no CSX or no international railroads thinking about the opportunity. So these were companies. We started buying one company that had pretty much zero EBITDA, about $100 million in sales, was by far the worst run state-owned company in Brazil. Those businesses was a disaster. Basic clients the way clients describe the railroad business in Brazil is that if they call several times, they eventually could get something transported. And of course, Brazil is a grain country, so to get grain out of the countryside in Brazil into the ports, you need railroads. So there was a big opportunity. In Brazil, railroads had only 5% market share of the global transportation network. So there was a lot we could do. So we bought the company. We put one of our partners, again, as CEO, because it was a very complex transaction. We had to lay off 7,000 people the day we bought the company out of about 10,000. So there was a lot of hard work that had to be done. Right away, we could improve the profitability quite rapidly. We start buying other assets. So we bought 2 railroads in Argentina in '98. We bought a second railroad in Brazil in '99 and a third one in 2000. In 2004, we merged into the largest. We actually took over the largest railroad in Brazil, and we created the one company that's probably one of the best regarded companies in Brazil. In spite of being a railroad, it's a very aggressive, very dynamic company. The level of technology that we have in that business in Brazil, it's comparable to any railroad across the world. We have a full automated network, best technology possible. Some basic things like having one conductor per train, that you need a lot of technology to do that. We have been able to implement from a company that was in the Middle Ages when we started. This is a public company in Brazil. We took it public in 2004, rather right before that big merger. We exit it's not here, 2009, but we exit late 2009. We sold the last piece of that company. And this is one that we are particularly proud of because we know that's a company that will continue to develop as a corporation. This was one of the first businesses to become corporations in Brazil, where you don't have a controlling shareholder, you have an active board, you have an active management team that has a stake in the business and run the business by itself. That business that started with a $100 million investment, of course there were mergers and there were many things in between, it's now worth about $7 billion and is one of the most active trade businesses in Brazil. And some of the things we created at AOL in terms of compensation, budgeting, control, goal setting for the year are the things that we apply in every company. So we use AOL very much as a benchmark internally for the things we want to do when we buy complicated companies and need to move forward. Equatorial Energia, the next one, is a business that I was actually the CEO of, and it's an interesting story. Equatorial, actually the underlying asset below Equatorial, it's called Semar. It's a utilities company in the most poor part of Brazil, in the north, in the very north of Brazil. The company was privatized in 2000, was bought by a U.S. utilities company down in Pittsburgh called PPL, Pennsylvania Power and Lighting. They did very poorly. It was a combination of the wrong capital structure because they financed the company with short-term debt in Brazil, which can be very dangerous. Not really turning around the company. The company in 2004, when we got involved, it was still managed as is stated on the company, so they have not taken the necessary measures to change the company. And they were not very fortunate in terms of timing. Of course, they bought the company in 2000, and 2001, 2002, 2003 were very tough years for Brazil. So when they got into 2003, the company was very close to bankruptcy. So basically what we did is that we bought the company from them for $1, and we worked with the lenders of the company to restructure completely that. The company had in 2004, 85 million reais in EBITDA, and this is not real EBITDA. Probably the company had 50 of recurring EBITDA and had 800 million reais in debt, and this was all short term, and it was all past due. So what we did is that we worked for about a year to find a new capital structure of the company, negotiation with the lenders, and that was really important. We ended up having a lot of leverage. So when we bought the company, there was still $400 million there, but on terms they are not market at all in Brazil. You cannot find anywhere because the guys were already there and they didn't have any option. The company was going for bankruptcy. So this is the one exception where there was a lot of value created in the financial engineering that took a lot of time, but it was not a typical LBO. It was really a turnaround, a company getting out of bankruptcy. After buying the company, which we closed the deal in May 2004, I actually, as I said, stepped out of GP and become the CEO of the company and started a massive program of change in the business, which was very straightforward, common business sense of how to change a business that is absolutely wrong. So we had, unfortunately, to lay off about 2/3 of the workforce. We had to replace a third, so we ended up about 2/3 what we started. There was massive amount of internal corruption in the company. There was, the political community was all embedded in the business, so we had to get politics out of the business. Take a lot of corrupted people out of the business. Have to renegotiate pretty much every service contract. We have to negotiate a new tariff increase. The company had the wrong tariff, so we had about a 20% real increase in tariff. With all of that, and really there's nothing very special in terms of what he did. It was really just basic common sense of how to turn around the business. We increased the EBITDA to about 300 million reais in 06 and 07. We took the company public in 06 with a very clear objective. We want to raise capital to do the same thing with other companies that were in the same situation in Brazil, but that were still owned by the federal government. So companies that were absolutely destroyed, and we thought the federal government would sell those companies. They ended up not selling those businesses because of politics in Brazil. Privatizations stopped in Brazil in 2004, 2005. Nothing was privatized after that. So we actually decided to exit the business in 07. Of course, the combination of a lot of leverage, very little equity. We just put $10 million in that transaction. Massive improvement in EBITDA, translated in just a normal return. We made 34 times our money in that deal. Don't expect to do that again, unfortunately, but that one worked quite well. After selling that, of course, I went back to GP back in 07. Gafisa, and this, we still have time, so there's two more. Gafisa is one of the early transactions that we did in GP. Actually, it was the first transaction that I did in GP back in '97. And it's a real estate developer. And this ended up being an excellent deal for us, but we got the timing somewhat wrong. What we saw in '97 was that Brazil was going through a stable phase. So interest rates eventually would go down. We would start to have a mortgage market, so consumers would start to have the ability to finance, to purchase a home. That would have long-term stability in the country, and of course the residential development market would develop because of that. So initially we did get it right, but not in the proportion that we expect that to happen. So again, it was a traditional family-owned business in Brazil. This one, we didn't start it with control. We started as a 50-50 joint venture with the regional owners. Between '98, which was the first year that we were there, and 2002, we were actually co-managing the business with the regional owners, and the CEO was still one of the original owner of the business. Didn't work out that well. For internal reasons, we could not really do the changes we want to make in the business. And second, the whole development that we expected for Brazil, and that's, again, we don't like to bet in macroeconomics because not always happen like you expect, took a lot more time than we expect to happen. So between '98 and 2002, Brazil, rather than moving forward, actually moved backwards. It was a terrible time. So interest rates actually went up during that period. There was no growth at all in the country. We suffered for all the crises, and on top of that, the business, we couldn't manage the business the way we would like to manage because it was still a 50-50 joint venture with the founders. So when we get to 2003, 2004, the company was in pretty bad shape. This could have been one of our worst investments. It was highly leveraged, was not doing well. The business was growing a lot less than it had to grow given the amount of leverage and amount of capital we have deployed. So we negotiated to buy the founders of the business and become the sole controlling shareholders. We bought Sunzel, the Chicago investor, to be our partner. He had been very successful with a residential development business in Mexico. So with his capital and some of our capital, we took 100% of the business. It started a more profound turnaround, put a new CEO that we know well, and then we had the development we expected. So because of Brazil, this ended up being a 12-year investment to us. We exited completely last year, the business that we started in '97. The business did so well as the real estate market in generally did in Brazil, then this ended up being a very good investment to us overall. And Gafisa is a great company. It's the #2 residential developer nowadays. It's another corporation. It's public listed, one of the most traded stocks in Brazil. But in spite of being a success, gave us two very important lessons. Is that you need to have control if you want to really change things as fast as you can. and don't put your bets that things will do well. So we do believe Brazil will do really well over the next 5 years, but we want to make sure that if it doesn't, or if it does worse, then we expect that we still will do well with our investors. Yep. Go ahead.
When you exit investments, when you IPO, do you usually IPO in the local market, or do you ever consider IPO in like the New York Stock Exchange or some other market? And is there a reason for it?
We usually do in the local market. And it's new. When we took one company public in the 90s, it was a cable company, so we took it public in the NASDAQ. Otherwise, investors were not comfortable investing in Brazil. So nowadays, every institutional investor is very comfortable about investing in the Bovespa. It's they know the rules. The rules are very solid now in terms of minority shareholders protection and in terms of corporate governance. So we are very comfortable in taking them public locally, and it's usually sell 60 to 70% of the shares to international investors anyway, in spite of doing it locally. So because it's faster, less expensive, we prefer to do it locally. When you become very large, for example, Gafisa, after we exited the business through Gafisa's listing in the New York Exchange. So at one point when you reach a size, and especially if you want to tap retail investors in the US, which is not the most important one, you are of course more important are institutional investors, but if you want to tap those investors, and in real estate you can, then you usually do a follow-on in the New York Exchange. So BR Malls, it's the last one I'm going to comment on, and I hope you have more questions afterwards. So BR Malls is a shopping mall company. It's the largest shopping mall company in Latin America. What we saw, this was back in 2005, 2006, was a very fragmented industry, and one that clearly would benefit from two trends: the growing middle class and the growing wealth of the Brazilians, and the decrease in interest rates, and being much cheaper to construct and to make long-term investments. And of course, more importantly, there was a clear target in the industry. So we identified the number 5 player in Brazil, which had probably, 2 or 3% market share of the shopping mall industry. The largest player in Brazil had like 5% market share. The top 5 players combined has less than 15% market share. In the US, the top 3 players have now 85% market share of the shopping mall industry. So it was clear to us there is something there. It's highly fragmented. Of course, it is a real estate business, but there is a management component. We knew we could improve margins for a more financial-oriented, more modern organization. So there were things we could do to improve margin in the business, and there was a massive opportunity for consolidation. So we started with a small company, which was that number 5 player. We had 65 million reais in revenues and 34 in EBITDA 34 million in EBITDA. We make the investment actually early 2006, based on 05 numbers. We bought a reasonably good company, family owned. Was a company that has done really well for many years. Was founded by 2 Brazilians, back in the 60s or 70s. They did well for a time, but then one of them died. The other one was already like 75 or 80 years old, was more interested in playing golf than managing the day-to-day of the business. And shopping mall, even if you don't pay much attention, you make some good money. The money flows in. Of course, you can make more money if you pay a lot of attention. So he was very happy about the business, and he had multiple offers to sell the business. So we did we spent many months convincing him that there could be a better alternative. And the alternative was, you sell us 70% of the business for a lot less valuation-wise that you would get selling 100% of the business, because we're not going to pay what someone that has synergies and everything is willing to pay. On the other hand, we believe that the money you're going to make out of the 30% you're going to keep will more than compensate not selling the business today, and you're going to fully benefit from the upside that's going to be generated from consolidation, from the growth of the business. We were successful in doing that. So what happens is that we made a capitalization of the business, and we bought some secondary shares. We partnered again with Sunzel in this one. So we are half and half on that 70% with Sunzel initially. Bought 70% of the business, changed the name, the structure, the CEO. I think every single manager of the business. Within a year, we made, I think, 50 acquisitions of either companies, small shopping malls, pieces of shopping malls. With that track record, we could take the company public in 2006. So we raised a lot of capital, and we actually have made a follow-on offer. We just exited that business. We sold our shares in the market a couple of months ago. And we could become the number one player in the market. So in this one, I think the combination that we had was a great opportunity to consolidate, and I think we had the ability to, because of many years doing that, buying complicated companies in Brazil, I think we could implement that consolidation strategy a lot faster than our three major competitors, who are established shopping mall operators in Brazil that nowadays are smaller than us. And we put a lot of management expertise into that. And I think of course, we are very proud of the consolidation, but we are very proud of that numbers. The business that we originally started had about 40% margin, EBITDA margin. Shopping malls, they generally have very high, it's a real estate business, very high EBITDA margin. So it was in the 40s, 50s. We took BR Malls margins after the acquisitions, the consolidations. We concentrated, every shopping mall was managed as a separate entity with its own human resources, its own finance. We centralized all that in a single unit, including shopping malls that we don't own. We only operate, after doing all that, we have about 77% market share. That's larger than any of our competitors in Brazil, and it's larger than any of the large companies in the US. So we combine not only the growth opportunity through consolidation that was great, and actually now we are also growing the business organically, but also we did a lot of how to think the business and managing a business that usually people don't pay attention to cost because it's so profitable, margins are so high that they don't care. Putting a lot of attention into improving margins where we can get and making as much money as we can. So if you look on all the things, of course we have our mistakes as well, but I think those we try to bring the successes. I think always, when we look at a deal in Brazil and we were successful, always deals where there were key variables that were under our control and things that we could change and could generate a lot of value through a number of years, but with massive work. So usually the deals we do are very complicated. It takes a while to turn around the companies, to take the companies to the level we are. A lot of times the companies that we buy on the first and second year, their performance actually they have a worse performance than they had in our hands, because before that you have the owner, and somehow that guy have been managed that business for 30 years without systems, without a good ERP, without a budgeting system that works, but he has 30-year experience, so he could do it. And we buy the business. And before the systems are in place, the right management team is in place, the controls are in place, actually the performance goes down. But over time, we've been able to improve margins and to create companies that we are quite proud of. They're ranked among some of the best businesses in Brazil. That was it. I hope you have some questions. Yep.
So I was working before coming to where I was working in a mid-market firm in Spain, and it was purely focused on Spain. And we always said that to make money in private equity in Spain, you have to be Spanish, and it was obviously our pitch for this. However, there were a number of funds, international funds, that without being tied up to this geographic region, they were actually making money in Spain. So what's your view regarding having that in Brazil? What's your view of international funds going eventually to Brazil, opening an office or even making investments from remotely?
Yeah, I think that's a very good question. And the way we take the one is that it's going to be hard for international firms to do what we do. I think without being local, and being local doesn't mean being Brazilian. Having, Advent, again, is our major competitor. It's not a local firm, but they are local. They've been there for 15 years and they've done, very well. But without a local presence and a local team, someone that really understands the business, can hire a new management team, I think taking control of family-owned businesses, of complicated business, and turning those businesses around, or strategically reposition those businesses are going to be very tough. That doesn't mean that you are not going to make money otherwise. There have been funds that made money in Brazil over the last 5 years with minority investments, where you basically were keeping the same management team in place with no turnarounds. I think those are going to be tougher and tougher. As the market develops, as there is more competition, if you just want to buy 20% of a solid business that's fairly well run, your return is probably going to be something very similar to the return of the market. Of course, as over the last 5 years, the public markets in Brazil were booming. So if you bought a good asset at a decent price, there are pretty good chances that you made money. But I think what investors want from us is something that's absolutely different from that. They want to make money regardless if Brazil is doing well or not. So if you look at our 90s, the funds that we raised in the 90s, we are not absolutely happy about our performance because we suffered a lot from the devaluation of the currency, but we did a way better than the market did during the 90s because there were businesses where there were variables under our control that we could change and we could increase profitability a lot. I think those deals are going to continue to be going to be on the hands of the locals, but more traditional, if you want to just buy 20% of a good company, they're going to be, international firm can do well. And many have done quite well recently in Brazil. There have been, number AIG, for example, made an investment in a local airline in Brazil, and they made a ton of money. They made 10 times cash on cash, took the company public. I think those are going to be harder and harder, but yes, you can. And I think they're going to be firms that are going to establish themselves. So I think, 5 years from now, there are going to be more firms in Brazil there nowadays, but it's going to still be a small number in our view.
You say that it's very important to be able to have control and to implement the changes. Why? It seems to me that there is a tendency to put in people that is working for GP in executive positions. What's the consideration between bringing external people with expertise in the industry that can turn around and make the changes faster and probably with a higher rate of success?
That's probably the question that we take the most from investors. And it's not really a tendency. We do that often, but we don't do that in every case. We don't have that many people to do that. But we have a strong view that the changes that we implement in companies, and we only invest in businesses where we can implement those changes, are more common sense business decisions, strategic decisions. And we don't want to invest in a business where industry expertise is going to be the key variable, because we don't have it, and we are not the best one to have it. So we are not going to invest in a business where technological expertise it's the key. We are not making an investment where knowing where the commodity prices are going to be in 5 years from now is the key variable. For the type of things that we do, we usually are looking for a CEO and a CFO that are the best ones to turn around the business or reposition the business regardless of industry experience. And most of the time, we invest in sectors they're still dominated by family-owned businesses, so it's going to be very hard to find someone that has local expertise, know the local markets, know to navigate the Brazilian or the Argentine or the Colombian economy, and also has industry expertise. So we usually prefer the right leadership skills coming from outside than from outside. But of course, we do need industry expertise. So in complement to that, we usually gonna find people from the industry that will be the operational manager, the chief operational officer, will be, we will complement our skills. For example, in Equatorial, I didn't know anything about, how to run a utility company back in 2004, and I still don't know anything about, how the electric grid works. But we had, I found, someone that was, and we found those guys in big companies. This was a manager, has been a manager for 10 years, was not going anywhere in the big company, old traditional company that he was. He was a talent. He's actually the CEO of the company now. He didn't know what EBITDA was when he joined us in 2004. So I think that combination of the right, of the right business skills with the industry knowledge is the one we seek for. If we can find a CEO that has both, the best, but it's really hard. It's really hard to find. Yep.
So Chapethics majority position usually demands a lot of time from an investment team, but yet you still have a very small team of professionals, 14 for $1 billion. How do you manage this time-wise, and especially as the senior partners become more wealthier and you feel it start becoming soft and less time-wise engaged in those companies? So.
I think two things. One, we are trying to do larger and larger deals. So what we try to accomplish over time is we actually have less portfolio companies, in spite of having much more money under management. We have a smaller number of portfolio companies today that we had back in '98, and we have a much larger team. So we want to do larger deals, so we can spend more and more time with portfolio companies. We have 11 portfolio companies right now, and we should remain on the 10 to 15 level. If we have 6 to 7 partners full time, and each partner is seeing up between 1 and 3 companies, is probably okay. But we do have that in mind all the time. So that's for the first part of the question. And usually the way we structure is that there is one partner and one associate that is responsible for every investment. Of course, I sit in more than 2 boards, but there's 2 of our portfolio companies that I'm the focus point. I'm the one that's talking every day with the CEO and so forth. For the second question, I think this is the greatest challenge for a private equity firm. It's what happens over time. How you guarantee that the partners they just stay home and stay on the beach or playing golf. I think one good thing that we have is that all of us have the vast majority of our wealth tied up to GP stock. So the fact that we are not just a general partner, but also we are very large investors and we have a capital base. For all of us, almost all our wealth is in GP stock, and it's not on GP11, GPIV11, which anyone can buy and sell. It's tied up to the shares of that holding company that controls GP. And that holding company is structured as a partnership under rules that partners can only sell to partners. So I cannot turn around and sell my stake at GP and go do something else. And if I stop working, actually the other partners have the ability to buy back my stock. So we make sure, and that's why we bought the founders of the firm back in 2003, because they are great guys and they're amazing guys and they continue to be great friends. But we were doing all the work and we own a minority stake in the company. So nowadays, every single partner at GP has most of its net worth tied up to not only GP stock, but the stock of that partnership, and is working absolutely full-time for the firm. Yep.
In your funds themselves, can you talk about your investor base? I mean, how much in terms of your LPs is Brazil versus international, and how has that changed over time? Sure.
It's almost zero in Brazil. It's not zero anymore, because in the last funds we raised some capital with wealth individuals in Brazil into a separate structure. Up to now, up to last year or up to 2 years ago, there was no legal structure in Brazil to put a private equity fund in place. One. Second, institutional investors in Brazil have, in our view, a totally wrong take on private equity. To start with, they demand control of the investment committees, which is something that, in our view, it's plain stupid. If you're paying someone to manage your money, they have to be the ones that are taking the decision. So because of that, historically, we didn't raise any money in Brazil. Our investors, that has evolved over time, but it's usually mostly US, but also Europe, Middle East, and Asia, typical private equity investors. So you have the large endowments. We haven't got pen to invest yet, but we try every fund. So the large institutional investors, the large endowments, large pension funds, sovereign funds, a lot of family office. And once in a while, we get the hedge funds. When they get the hedge funds, are really excited about the world. So back in '94, we get many hedge funds. In the 2007 fund, we have many hedge funds. The current fund doesn't have any hedge funds. So that's what varies over time. But it's very typical from a typical US or European large private equity firm. He was first.
You mentioned that your focus was in Brazil, but that you were also open to looking at opportunities in other countries in Latin America. Do you currently own any companies outside of Brazil or have an office in any other country?
We don't have an office. We had an office in Mexico for a while, but we decided that we could cover Mexico from Brazil, just because Mexico is very tough for private equity. The same way we cover Colombia, we cover Argentina, Chile, and some of the smaller countries from Brazil. I personally travel a lot throughout Latin America. We have one investment that started outside of Brazil, but which San Antonio, which was mostly Argentina when we bought. But that company has made investments in Brazil, and we actually moved headquarters to Brazil 2 years ago. But it's still 70% of the operations are outside of Brazil. We're very open to investments. We are not very keen in Venezuela nowadays, but we are very keen in Colombia. We believe Argentina will certainly turn around next year. We like Chile, we like Mexico, so we are very open for opportunities everywhere.
I've heard a lot of information that talks just phenomenally about the opportunities in Brazil. There's been a lot of positive news. What are some of the risks that the country is going to face over the medium term, whatever that is?
That's it's hard to be Brazilian and see people excited about Brazil. I spent my 10 years of professional life convincing people that Brazil was a reasonable place. So it has been an important change. And I think Brazil, it's pretty safe right now. I think if you look at from a political and economic standpoint, things will not really change. I think what could happen in Brazil, a catastrophe in China. If you have if the global demand for natural resources suddenly crashes, Brazil would suffer a lot, because a lot of the Brazilian economy is dependent on iron ore, steel, a bunch of basic products. But even then, I think we would turn around okay, because we are more insulated economy than in other places. I think from an investment perspective, you need to be worried. Whenever there is, you are the flavor of the day, you have to think about what you're doing. The way we see GP, more and more, we're going to be out of investment bank run auctions where there is this great Brazilian business being sold that's well run, is very stable, and more the things that we're going to be doing are things like Equatorial or things like BR malls. They're very complicated. That demands a lot of management time, a complete turnaround, because that's where you have private negotiations. Price doesn't really, the multiple you're paying doesn't really matter, because the profitability of the business today has nothing to do with the profitability of the business 3 years down the road. So I think what we as investors are worried about it is that for very public, easy transactions, there are going to be a lot of competition and demands a lot of discipline from us. When there is, everyone is looking at, there's one transaction, I cannot mention even the sector, but there's one transaction going on in Brazil. It's about $500 million right now. Very hot sector, sexy sector. Is a company that we, as Brazilians, would have a very hard time buying. It's a business that it's very tough to run, very complicated, very different dynamics from the US. It's run by one guy that is extremely capable and smart. We hate those businesses. We like businesses that are being run by people that we believe are worse than us, not better than us. So yeah, because then we can do better than us. So we look at the business, there's no way they can do better than that guy, and there is no systems, no human resources, no budget. It's the guy is an entrepreneur. So we wouldn't touch that business. There are 5 of the big international funds they're going to pay a very nice multiple for the business and they're going to be very successful in selling. They may as well make a lot of money because it's, the macro picture is very positive for Brazil. It's a sexy sector, so things may as well move in the right direction. But it's something that we would not bet. So what we are afraid of is that we need to have a lot of discipline. And if it's not the right price, we don't invest. It's our own capital. We don't need to invest. Yeah.
How do you see the international expansion of Brazilian companies? Recently, Vale has made significant acquisitions. And who do you think the next global Brazilian company?
I hope Magnesita becomes #1 in refractory. We are #3. We were #5, so we're getting there. I think we will continue. I think there is, one thing that we like about, we also like about Brazil. There is very good talent in Brazil. We suffer a lot. It's very, we have massive amount of bureaucracy. We pay too much taxes. It was hyperinflation for 20 years. No growth for another 20 years. So I think Brazilian managers are generally very well trained in operating in tough environments. So I think if you combine that with sectors where there is an intrinsic advantage for Brazil, we usually relate it to agribusiness or natural resources. I think it's a great combination. So it's not a joke that we believe Magnesita will be in the #1 in the world. We certainly believe we will. Because we believe it's a great company, it's very well run, it's a great business, and it has by far the best mining natural resource in magnesium. The mine that we have in Brazil to extract magnesium is the cheaper magnesium in the world. It's always going to be, and we have 100 years of reserves. So we want to turn that intrinsic competitive advantage into something that we can explore globally, and we already are. We are everywhere. We are, from Brazil, we are managing our business operations in China, in Europe, in the US, pretty much everywhere.
Yeah, I have a question on how PE can exploit the competitive advantage of a certain country, and I was wondering whether there is any way to make money out of soccer.
That's a very good one. I would love to make money, soccer. And I tell you, in '97, that was a long time ago, '97, '98, we spent a lot of time looking at soccer teams. And some of the international funds made investments in soccer teams back then. All of them lost 100% of their capital. Unfortunately, soccer in Brazil, and please don't take that the wrong way, it's a very dirty industry. It's a lot of politics. Business practices are not the ones that we believe on, and clubs are not organized as real corporations. So it's tough to get excited about it. It is. I know a lot of people that made money basically trading players, but that's more like it's not an institutional business that we will be able to be involved with.
Sounds like Turkey to me.
Yep.
Can you talk a little bit more about the opportunities and challenges related to purchasing family-owned businesses, as well as in terms of running or restructuring those businesses which were used to be owned by families?
Yeah, it is an interesting challenge. I think there are two types of businesses that we buy that are family owned. The easiest ones to turn around are the ones that don't make any money. There are many of those. For a reason, they were making money in the past. There was a generation change or competition increasing in the market. So there are businesses that have a strong culture because they have been there forever, and they have one way of doing things. But because they're not making money, you come with a different proposal, a different way of doing things, and people are fairly open to that. And you can show improvement in results very fast. For example, Magnesita was making a lot of money before we bought it, but we could pretty much double EBITDA margins within. I look at Frederico because he used to work with us, so he probably has better numbers than I have. But we pretty much double EBITDA margins in about a year. It was such a great asset, great business, that in spite of the fact that it was not really well managed, was making a lot of money. So these are the businesses that are easy to turn around as a family-owned business. Because when you put the right compensation structure, you put the right people, you hire, bright young people to work in the businesses, you put variable compensation, you get the right incentives, you put a new ERP system, things start to get in the right direction. So these are the ones that are easy. The ones that are more tough to manage are the ones that have a very talented entrepreneur manage the business. These are much harder to take over because usually they are making money. They're probably making less money than they could, but they're making money. They have a very strong culture. They have a way of doing things. And one thing is putting a new way of doing business in something that is, it's in a very tough situation, but something that's doing relatively well and going there with a new culture and changing things. If the company is doing well, it's quite challenging. So it takes more time and you need to be careful. Usually involves two things, getting new people into company, but also finding, and that has happened in every business that we bought. There are many, many very talented, hardworking people in every organization. So you need to find, those people that have been there for 25 years and for the last 10 years have been really not satisfied of the way the company was doing, and then putting the people on your side to be your allies and implement the turnaround.
Let's say a wealth family is selling their company to you and they're taking probably a lot of cash. What's going on with this cash? What are they doing? Are they investing in a booming industry in Brazil? Are they taking their money out of the country? How does it work?
Usually, I wouldn't know. Depends on their fiscal structure. Most of the time, it's so much money. If you're talking about that side of transaction, that they will put together a big family office, and they may as well invest in our funds. They will start. They will put a structure and invest that money around. A lot of them will put a lot of money in real estate just because they like the security of real estate. But that's one of the toughest parts of convincing a family to sell their business. Where do I put the money? LIBOR at 1% a year is not very exciting as an investment option. So, and our hedge funds are not, after 2008, don't sound that exciting as well. So that's part of our convincing. It's showing that there is alternatives and seeing they can manage their money.
So you think about GP was a pioneer in the sense that it was one of the first GPs to go public, more or less at the same time Blackstone went public. But in addition to that, you also issued perpetual debt at the holding company level. So you can talk a little bit about the rationale behind it.
It's just leverage our returns. We figured that we can have in our own balance sheets an amount of some leverage as long as it's long term and it's in a level that we can easily manage with the flows that we get from the funds. So actually we have at a net asset value basis, we have about $1 billion in assets. We have about $700 million in equity, about $200 million in a perpetual bond. Perpetual bonds are great because you never have to pay them back, so just paying interest. And by the way, they are a thing of the past. So this is something that's part of the finance history. I don't believe a private equity firm will be able to issue perpetual bonds again. And we have about $100 million in bank debts. So I think that's 30% leverage ratio, very long term. I think it's something that we can manage.
The two biggest sport events will happen in Brazil in the medium term. We're talking about the World Cup in 2014, the Olympics in 2016. What are your views if there are opportunities and if you're willing to pursue them as a local investor in Brazil?
It's a tough question. Somehow we're going to benefit from that because we have the third largest hotel company in Brazil. But the largest investments are going to be infrastructure. So Brazil needs new airports, needs new roads, a bunch of stuff, which is probably not for us. I think it's a great investment opportunity. There is money to be made. We usually don't like the greenfield risk return reward. So it probably won't be an important investment team. Directly, indirectly, I think it's all part of a great phase for Brazil. I wouldn't be able to tell if it's good or bad for the country. I basically don't know. I think it's good. But generally, I think there is global excitement about Brazil. There is a lot of money flowing in, and it's generally good.
Brazil has a very developed manufacturing sector, and a lot of them, they complain about the interest rate and the natural resource that's it's kind of happened, the Dutch disease again in Brazil. Do you see this as a problem for investing in the manufacturing sector, or something that's more labor intensive and exported oriented?
I think if you are, it's not easy to be in an industry in Brazil where you directly compete with China. So I believe exchange rates will remain. There will going to continue to be a lot of pressure against the dollar in favor of the real. I don't believe that's going to change. So the reality of the matter is that if you need 2.5 reais per dollar to make money as a manufacturing business, you're probably dead. And I think if we were, and we have two manufacturing businesses, and we like them. It's not something that we don't look at, but nowadays we will look at a business only if we can still make money and we can still compete with China at 140. I don't believe it's going to get there, but we want to make sure that's still there. So the truth of the matter is that Brazil still has, coming back to your point, David, there's still several challenges there. We have a tax system that's absolutely crazy, We have more red tape than pretty much any other place around the world. So there is many challenges. So if you are in a sector where competition from abroad is a big factor, it's not tough to navigate. So if you are from the textile industry, it should be a huge industry in Brazil. It has, it's probably about 1/10 of the size that it was. Brazil at one point was, it's amazing, was the largest exporter of shoes in the world, and the shoe industry is basically dead. There's no one left. So that we always look at the China effect when we're looking at the business. Is that something that China will be able to produce cheaper than we produce and will kill us? And there's several businesses that look pretty profitable nowadays that if the real goes to 140 would be dead. So we do look at that carefully.
Octavio, thank you very much.
Thank you.